Brian Clark, based in British Columbia, and we are doing the British Columbia content version of Fundamentals of Income Tax. And this is part 9 of the course, corresponding to chapter 8 in the textbook. Everyone should have completed their assignment number 1 by this time. I will be reviewing those answers at the end of this class, but those answers will not be part of this recording for obvious reasons. So if you need to check something individually, please speak to your individual instructor. We will be stopping the recording before we get to that. But before we get to that, we have some other things to cover. So welcome back, everyone. Of course, I hope those of you online have had a good Thanksgiving. We had a pretty good one here. Everyone in the class here seems pretty happy. Just a reminder to everybody, when you come in, and particularly if you lose connection and have to reconnect, remember the steps for checking your audio. In particular, you need to say yes when WebEx prompts you to at the end. WebEx, of course, a temperamental online platform. All right, as always, there's no such thing as a bad question. Please feel free to send any questions that you have. Some of you out there in the internet, not in my class, have been sending me the occasional question, and that is perfectly fine on terms of general theory and things like that. But just bear in mind, for anything related to marking, assignments, things like that, you do need to speak to your assigned instructor if it's not me. All right, so last class, before Thanksgiving, we talked about the rather large topic of investments and the 3 major types of investment income, broadly speaking. And class, do you remember what are the 3 types of investment income that we talked about? Dividends is one. And before we move on, what's special about dividends? Do you remember? Anyone jump in? There's a gross up for Canadian dividends. That's right. That's right. Now, good job, Diane. Now, if we had to explain to someone comes to us, we're doing their taxes, they don't understand what that means. How would we explain the concept of grossing up? Is there a simpler way we can describe it? So remember, when we're talking about taxable Canadian dividends, they receive a special tax treatment because they have already paid Canadian corporate taxes. So in order to reflect that, we take the actual amount of dividends received, that is the net amount of dividends after corporate tax has been paid. So in order to give a tax credit for that corporate tax, we need to turn the net amount back into the gross amount. This is called grossing up. So we multiply the dividend by a factor of over 100% in order to make it, roughly speaking, the same as the gross amount of the corporate dividend, and then the taxpayer receives a tax credit based on the corporate tax rate. And depending on the type of corporation it is, it will have paid different corporate rates to begin with, so the tax credit will be different correspondingly. Eligible dividends are eligible for the full dividend tax credit. Other than eligible dividends receive a smaller amount. Those are the 2 categories. And remember, this tax treatment is only for Canadian taxable dividends, taxed from Canadian taxable corporations. Foreign dividends do not receive any special treatment. They are just treated the same as other investment income, which is the second category of investment income we are talking about. What other investment income is treated like foreign income, foreign investment income? Not capital gains grant, but we will get there. With interest. So, for example, interest on a bond, interest on a bank account, interest on treasury bills. This receives no particular special tax treatment, but it is combined with any foreign investment income, and it is put on the return line. Does anyone remember the line number? One two one zero zero. Excellent, Rajat. All right. So, so those are the two main types of investment income that we see. The taxable dividends receive the special treatment. Other investment income receives no special treatment, but it is investment income, so you can claim investment expenses as a deduction against it, which we also talked about last time. Capital gains are the third category of investment income, but they are taxed so differently that often people speak of investment income and capital gains. So while capital gains are technically a kind of investment, a return on an investment, often you cannot claim investment expenses against them. Capital gains, the special treatment, as Grant said, only 50% of the gain is taxable. Historically, it has been higher at different points in history, but for the last 20 years or so, it has been stable at 50%. There was a plan to change that amount in 2024, but that law never came to pass. All right, property flipping and principal residence. So first of all, there are these both have to do with capital gains. And guys, what schedule do we use to report capital gains? Schedule 3. Excellent. All right. So what does it mean? What's significant about a principal residence? What's the special tax treatment for a principal residence? If you declare the sale and designate it as your principal residence, it is exempt from capital gains. It is not treated as income, right? But you have to declare the sale and you have to make the principal residence declaration. Now, property flipping, when does property flipping apply? Can anyone tell me? Virginder's got it. It's when you sell a residential unit within a year. So this doesn't apply to business property or just land or things like that. But if you sell a residential unit within a year, then in order to discourage speculation driving up the cost of housing, the government treats that sale as business income unless there's an exception. Can anyone remember one of the exceptional circumstances which could apply here? Right, death of a taxpayer or sudden disability rendering you, for example, unable to live in your five-story house with lots of stairs. Exactly. Right. So there are exceptions for cases where where a life event has happened, which means you had to sell the property within a year, but otherwise the property sale will be treated as business income, and so it will not receive the 50% exemption. Family circumstances, certain family circumstances, yes. Relocation for work as well. Excellent. All right, good stuff. So any other questions from last time, guys? All right. If not, let's move on to our new material. Now, Chapter 8 in the textbook is about what we call registered plans. And all of you should have read or at least skimmed the chapter beforehand. Our first poll question is going to assume that you have read a few things. So we'll get to that in a moment. But registered plans, the short version is any kind of registered plan is an investment plan, normally for an individual, as opposed to a trust, which is sheltered from tax in some ways. So the major one that comes up most commonly for people is for registered retirement savings plans. So we're going to talk about contributing money to an RRSP or a similar plan called a PRTP. And sometimes you can take money out of these plans to use them for specific purposes. So we're going to talk about the home buyer's plan and the lifelong learning plan. We're also going to talk about a couple more registered plans which are less common, registered disability savings plans and tax-free savings account. Right, but our main focus is going to be on RRSPs because those are the ones which are most common and have the most notable effect on the tax return. So by the end of this chapter, you should be able to list what will affect a taxpayer's RSP contribution limit, how we claim RSP deductions, and when we would want to claim them in the current year as opposed to carrying them forward for the future. You're also going to be able to talk about the home buyer's plan and the lifelong learning plan and how those are repaid. You're also going to be able to talk about setting up a registered disability savings plan and the rules regarding tax-free savings accounts. There is a fourth type of registered plan called a RESP. We will talk about that when we talk about students, but in very broad terms, it is similar to an RDSP. All right, now at the end of class, we are going to talk about assignment number 1, which of course is chapter review problem 7-1, but we will not be recording those answers. All right, but so before we get into our new stuff, let's see how well you guys absorbed what you read. Let's have a little poll here about the difference between some of the concepts we've seen. So for someone in the second tax bracket, so all of these assumptions, all of these assume someone is in the second tax bracket, so it's the same situation for each. What would save the most tax? Contributing $15,000 into a TFSA, $12,500 into an RRSP, or $10,000 for the home buyer's amount. All right, let me pull up the correct poll question here. Set the timer for 1 minute and see what you think. And for those of you who didn't get a chance to read the material, please take a guess. And see what you have. All right, so 1 minute. Question over here. Okay. Some people haven't answered yet, but take a stab at it. After all, this isn't for marks. Excellent. All right, most of you got this one correct. So it sends out to you. All right, the correct answer is, why is my mouse not working? There we go. There we go. So the correct answer is B. So as we're going to see, the home buyer's amount, although this sounds similar to the home buyer's plan, the home buyer's amount, which we've discussed previously, is a tax credit, whereas an RSP is potentially a deduction. So an RSP of the same amount, even assuming this was a $10,000 contribution into an RSP, that would still give you a greater tax savings than the home buyer's amount. TFSAs, though, do not affect taxes in the current year, as we will see. So an RSP can give you a tax deduction. So this is going to have the biggest effect. A TFSA would have no effect on the tax savings, and the home buyer's amount is only going to give credit at 15%. All right, so let's talk more about these RRSPs for anyone who didn't get a chance to read too closely in the textbook. So again, as the name implies, these plans are registered with the CRA, and essentially the idea is it's a private portfolio owned by you, the taxpayer, designed to give you some savings to draw on in your retirement. Registered with the CRA means you can only select certain types of investments, and you have to do this through approved investment houses such as banks. You can't just, put some money with your friend Dave's or something like that. Now, these are what we called a tax sheltered plan. And as we'll see, there's a tax deferral mechanism. So the shelter here works like this. When you put, say, $1,000 into an RRSP, it is a deduction. You are telling the government, please do not tax me on this $1,000 now, tax me on it when I retired. So the government says, fine, you're allowed to deduct the amount of your contribution into your RRSP. It's not included in your taxable income in the year you make it. And then during the entire time that it is in the plan, it can grow tax-free. The money is only taxable when it is withdrawn from the plan. Now, as you can imagine, most people, when they are working, they're in their peak income years, they might be in a higher tax bracket, and most people, when they retire, will be in a lower tax bracket. So if you do it right, you are deferring the tax on this income, possibly decades until you withdraw it, and you may also only have to pay you may be paying at a lower tax rate overall. So if I put in the money when I'm in the second or third tax bracket, and I pull out the money when I'm in the first tax bracket, then I'm not only delaying the tax, but I'm paying less tax in absolute terms. Now, it is possible for this to go wrong. Sometimes you have to withdraw money prematurely because of an emergency. So you may wind up having to pay more tax if the timing is really bad. Or if, for example, you are fantastically successful in your work life and when you retire, you're in a higher tax bracket than when you initially deducted the RSP contribution. But in general, that's the theory. You are putting off the tax potentially for decades, and you're paying less tax in absolute terms. Now, in order to claim the deduction, you have to first declare the contribution on your tax return, and then you can decide how much you're going to claim. But you do need an official RRSP receipt from the bank or investment house. Now, you can contribute into your own plan or to a spousal plan. And this is an interesting wrinkle on it. So this allows you to set up you to get the tax credit while you set up essentially retirement savings for your spouse, who, for example, might not be working, might not have a lot of working income. So it allows you to provide for your spouse. Sorry, the power cord just hopped out of my computer. Hopefully I didn't lose sound. There we go. All right. Let's see, let's get that. Yes, my screen went black for a moment, which is never good. All right, but you guys are all here. You can all still hear me, I hope. Fantastic. All right, good. Yeah, always worries me when that happens. All right. Okay, so now there is now. Let's go back one second. Um, Conceptually, I think it's helpful to understand conceptually how retirement, say, RRSPs came about. You will notice that the idea here is similar to pension plans that you do through an employer, RPPs, registered pension plans. The overall policy trend, the theory behind all of this is that governments noticed that private industries were tending to get out of the pension business and were not uh, offering company pension plans often. So the government, the plan for a few decades was to encourage private citizens to set up their savings and set up their own pension plans. This is on a society-wide level. This has perhaps been a little over-optimistic, although we don't need to get into that very long discussion right now. But the idea is to give you, someone who maybe works at companies where there hasn't been pension plans, an opportunity to at least try to set up your own pension. Pooled registered pension plans are an interesting sort of hybrid idea. This is a relatively new option, and it's aimed at self-employed taxpayers or employees of small companies where it just isn't feasible to have a company plan. The idea here is that these plans allow employees to have benefits of a company-style pension plan, but it can follow them from job to job. They're not locked into a single employer. We're not going to talk too much about PRPPs for a couple reasons. First, they're very new. They're still uncommon. Many provinces have not fully implemented these yet. And also, they generally mirror RRSPs, and all the RRSP rules apply, except that with PRPPs, you can only contribute into your own plan. There is no such thing as a spousal PRPP. But these are relatively uncommon and are probably going to remain so at least for the next few years. Now, when we're talking about RSPs, it's important to understand a few of the terms. So the big one is deduction limit. This reflects how much money you can put into an RSP in a given year. And this is calculated using earned income. Now, earned income for RSP purposes is not necessarily the same calculation as for the Canada Workers Benefit or for moving expenses. So earned income, again, is not used elsewhere on the return, but it is meant to reflect the fact that these RSPs are aimed at working Canadians. So they're based on your employment income, in other words. They are intended to mimic employer pension plans rather than full-on investment income. So if your only income is from investments, say, this will not create any deduction room for your RSP. We're going to talk about all of these terms in more detail as we go on, not to worry. We're also going to talk about contributions and annuities, and the person who makes a contribution is a contributor, and the person who receives an annuity is an annuitant. And then we're going to talk about the process of deducting contributions that you make, and what happens when you have unused or excess contributions, and some of the potential problems and opportunities which can result. So first, the deduction limit. Now, this equation is not so important to remember because the deduction limit is calculated by this, for any taxpayer, is calculated by the CRA, and then it is on their notice of assessment. So this is the unused deduction room from the previous year, plus 18% of the taxpayer's prior year earned income only. So earned income, their working income, certain business income, rental income, things like that, but only to a maximum. So a maximum of $31,560 for 2024 and slightly higher for 2025. This is indexed for inflation. Now, The intent behind these plans are to complement or be used instead of an employer pension plan. If you also have an employer pension plan, the employer pension plan contributions are factored into your RSP deduction limit. So this, remember the box 52 that we saw on the T4? That was what was called a pension adjustment. And the pension adjustment, again, this reflects what was put into the plan. And this is deducted from your RSP deduction. So we take the unused deduction room, we add in 18% of the prior year's earned income, then we deduct the pension adjustment from the prior year, which reflects how much money went into private pension plans for the person. Then if a pension adjustment was reversed, then it is added in, or whether it is from the current year or past service. Those reversals, less common. They do happen, so it's important you know that they're out there. But you don't need to worry about them too much. Right. The deduction limit can be found on the notice of assessment. So let's have a look at the example notice of assessment in the textbook. Whoop. And right up here. So when you receive your notice of assessment, part of it will show your RSP deduction limit. So in this case, for example, it shows the previous deduction limit for 2024. No contributions were made. So the deduction room at the end of the year is the same. Then we add in 18% of the earned income, 1,960. So this is added to the 18,304. And so the contribution room for the 2025 tax year is 20,264. Good question, Sam. So as I was saying, earned income is not the same as total income, right? Because total income can include things like investment income, non-employment income, other types of income capital gains income, things like that. RSPs are intended to reflect your income from employment and a few other things. So your employment income on lines 10100 and 10400, your net income from business, which we're not going to talk about in this course, just be aware that also counts as working income. Certain CPP disability payments, because you're receiving those because you can't work. Net rental income is a type of business income conceptually, so that's why it's included here. Taxable support payments, we will talk about those more later in the course, but essentially this is alimony. And contributions to an amateur athlete trust. So amateur athletes can't work because they are busy being amateur athletes, so they get to claim those contributions. And postdoctoral fellowship income. So this is for professors and people like that who are conducting research and receiving a type of research grant called a postdoctoral fellowship. They cannot claim tuition credits for these type of grants. But they are allowed to include it in their earned income to raise their RSP deduction limit. So that's what's going on here. Right. Second. Yes. Let's pull this back up. There we go. All right. Now, one thing I wanted to make clear is the terms contributor and annuitant can be a little bit confusing. So I like to begin with the basics. So when we put money into a plan, you give money to the plan. You contribute money to a plan. So this is called a contribution. If the contribution is made correctly, the financial institution will issue a contribution receipt. It is possible to make it incorrectly. The bank doesn't file the right paperwork. In some cases, you put it into the account and then you withdraw it right away so it doesn't vest. So there are situations where you can put money into an RSP and then not receive receipt for it. In general, though, if you're doing it through a reputable financial institution and you leave the money there for a minimum length of time, they will issue a contribution receipt. An annuity is, for the CRA, this is a financial product which gives you a guaranteed regular income. That is an annual income. So annual annuity, right? These can be monthly payments, quarterly payments, or yearly payments, depending on what it is, but that's what it is. So you can see where these terms come in. The money you put into any pension plan, this is a contribution. So the CPP money on a T4, those are CPP contributions. The pension income that you receive from any pension is an annuity. So these are the generic terms. And this means that the contributor then is the person who contributes the funds, and the annuitant is the person who receives the annuity. That is the owner of the plan. So if you're putting money into your own plan, you are the contributor and the annuitant. If you're putting money into your spouse's plan, the spouse or common law partner is the annuitant. The person who puts in the money is the contributor. Because spousal plans can be confusing, this is why we want to stress only the contributor reports the contribution and can claim the RRSP deduction. And it is and the deduction limit that applies is the contributors. So if I want to set up an RRSP for my spouse and she has no income, she will have no RRSP contribution room. I can still put money into a plan for her. All right. One note about the earned income that we talked about. There wasn't room on the slide, but earned income is reduced, as we saw on that slide. Let me go back to the slide. Earned income is generally just employment income or working income or business income, income which has that general character. And the earned income is reduced by deductions of that character. So union dues, support payments, and employment expenses are deducted from the earned income. But again, this earned income figure is only used for calculating the RSP deduction. This may differ slightly from, at least potentially, from earned income when we're talking about moving expenses or the Canada Workers Benefit. Now, let's talk about spousal RRSPs. And again, whenever I say spouse, we haven't talked about this yet. Whenever I say spouse, it also applies to common law partners. And the difference between a spouse and a common law partner is a legal marriage. So when I say spouse, it means there's a legal marriage in place. A common law partner means there's a recognized legal status equivalent to a marriage, but it is not technically a marriage. We'll talk more about the difference when we get to talking about dependents in a couple of lessons. But for now, just whenever I say spousal, the same rules apply. So when you contribute to a spousal RRSP, those contributions are claimed by the contributor, affected by the contributor's deduction limit. And the normal attribution rules do not apply. Remember we talked about attribution? So contributions that you make to a spousal RRSP become the property of the spouse or common law partner. This is a major exception to attribution, unless the spouse or common law partner makes a withdrawal within 2 years of a contribution. Now, it doesn't technically have to be the same dollar going in. It can be any withdrawal, according to the examples I've seen. So if you're contributing to your spouse's RSP, you have to say, hey, you've got to leave this sit for 2 years. Now, there is a form called a T2205, and this has to be filed when withdrawals are made within that 2-year period, 2 calendar years after the year of contribution. In these cases, both spouses need to fill out the form T2205 to determine how much money needs to be included. So for us in this class, we don't need to worry about completing the form. Our only task is to understand when this is required, right? The only question you might see on an assignment or an exam would be whether a T2205 is required. And again, the purpose behind this is to limit the use of an RRSP as an income splitting device. As we said when we talked about attribution generally, if we did not have rules like this in play, then wealthy taxpayers would take advantage, would exploit these provisions to minimize the amount of tax they need to pay. We're going to talk more about this in detail in Chapter 11. But again, in this level, the only thing you need to remember is that there is a form that you fill out when a premature withdrawal is made from a spousal RRSP, and it's called a T2205. All right. Now let's talk about the contribution year, because this is a major way that RRSPs differ from most other things in tax. And this is a common source of errors and frustration that I see with taxpayers. So remember that most things in Canadian tax use the calendar year as the relevant year. So if I'm talking about your 2025 taxes, we are talking about income, deductions, other things that fell within the period January 1st, 2025 to December 31st, 2025. However, in order to encourage people to put money into RRSPs, there's a special exception for RRSPs. RRSPs are basically the only thing that you can do after a tax year is finished to retroactively have an effect on the previous tax year. So you essentially get 60 days after the end of a calendar year to put money into an RRSP. So the RRSP contribution year is not the calendar year. Instead, it starts on the 61st day of the calendar year and then goes for the last 10 months of the year from March to December, and then it ends on the 60th day of the following year. And if this falls on a weekend, this is extended to the Monday. Like other deadlines in tax, if they fall on the weekend, they are extended to the Monday. So looking at some previous year contribution periods can kind of illustrate what's going on here. So as you can see, in 2019 and 2024, the 60th day of the year, right? 2019 and 2024, the 60th day of the year fell on a weekend. And in 2024, it fell on February 29th. Oh, sorry. In 2023, it fell on February 29th. Sorry. For the 2023 contribution year for RSPs, it fell on February 29th because 2024 is a leap year. Okay, so you can see it kind of varies a little bit. Usually March 1st, if it falls on the weekend, it might be March 2nd or March 3rd. And if it's leap year, it will be February 29th. 2020, in 2020, you might say, 2020, that's a leap year too. But in 2020, February 29th fell on the weekend. But you can see the general pattern. Now, this does mean that RRSPs are divided into contributions are divided into two contribution periods. The first contribution period, generally there will only be one slip from any given bank for these contributions, because all the contributions for the year are totaled together for that calendar year up until December 31st. Then contributions in the second contribution period tend to generate individual slips because they can be done in a more staggered way. And this has the effect that occasionally someone will come in to do their taxes and they might not have their last contribution slip for the year. Now, the other confusing thing about this, which can trip up taxpayers, is that the contribution year may be different from the year that the contribution was made. So I, for example, will see someone coming in to do their 2019 taxes, and they bring in a slip from February 2019 because it says 2019 on it, and they say, this is part of my 2019 taxes. So then you need to go back and carefully say, okay, was this claimed last year? Was this declared last year? And if not, you need to make a change to the previous year's tax return. And, this is something I have to explain to sometimes very confused and even upset clients and say, no, this is on last year's, so it's not part of this year's tax return. You can claim it this year, but we have to declare that you made the contribution on the previous year's taxes. Now, obviously, all of this, it's intended as an incentive for people to put money into savings. And the logic here is because, remember, under our system, you don't know what how much tax you owe in a given year until you know what your annual income was, and you don't know what your annual income was until December 31st. So this allows people, if their annual income was higher than expected, to do one final thing to kind of take some of that excess income and put it into a tax shelter. All right. Are you with me so far? Everyone understands okay? Good. Again, if you've got any questions at any point through any of this, just let me know. RSPs in particular have a lot of moving parts. It's kind of why they have their own chapter in the textbook, essentially. Okay, so moving along. Now, when RSPs, because they're connected with retirement, age considerations come into play. So you can create an RSP at any age, but you have to be over 18 to contribute more than $2,000 in a year. As a practical matter, most people under 18 don't have working income and so won't have a contribution limit, but I mean, child actors, child musicians do exist. So in certain rare, high school students working a lucrative summer job in Alberta, say, working in the oil sands or something, like it's possible. So, but your limit is 2,000, no matter how much earned income you had, if you are under 18. Now, you can only contribute to your own plan until the end of the year when you turn 71, and you can only contribute to a spouse or common law partner RSP until the end of the year that they turn 71. So if you have one spouse is much older than the other, then that spouse can continue to make contributions to their spousal RSP until they reach 71. Now, when you make the contributions, then you have the option to claim them as a deduction in that year. So Schedule 7 is where we calculate RSPs in great detail. I will show you the Schedule 7. Let me just see if it's coming up on a future slide or not. Don't think so. So let's just have a quick look at the Schedule 7, just to skim, just so we've got an idea what it looks like. Schedule 7s do a variety of different things. So they, like some of the forms we've seen, they look a little more complicated than they actually are. There we go. So, and again, the first page is largely instructions. So the first section, you note all the contributions you've made into RSPs, and also PRPPs, if those apply. And the SPP is a provincial plan which currently is only used in Saskatchewan. So all you need to be aware of is that it follows the general rules for RSPs. So this is where we figure out the contributions. So you'll note we begin by taking any contributions which haven't been previously deducted, and then we enter contributions you made to your spouse or common law partners, RSP, right? And then this gives you your total contributions. Oh, sorry, if you're not reading closely, your plan or your spouse's or common law partner's plan. And notice the two contribution periods. So this one, the last 10 months of the year, and this one, the first 60 days of the following year. So first, you figure out your total contributions for the year. Then, if you have to repay anything under the home buyer's plan or lifelong learning plan, we'll talk about those later, that is calculated first, and the contributions that are left over can then be deducted. In this section, you calculate how much you have available to deduct, and then you have the option here of claiming less than what you have available to deduct. So we look at your deduction limit, and then you can say, notice here on line 18, you can specify how much you're going to deduct. So you can deduct up until your deduction limit, or you can deduct less than that, and then your contributions will carry forward. That can be useful in years where you're not owing a lot of tax or you're in the lowest tax bracket. So the unused contributions to carry forward will go forward. And then if you've made any withdrawals under the home buyer's plan or contributions to an amateur athlete trust, those can happen in Part E and Part F. So the heart of the form then is Parts A through C. Part A, where you figure out your total contributions, and in particular Part C, where you figure out how much you can deduct and how much you are, and decide how much you are going to deduct. Often the choice of how much you're going to deduct can be very tactical. I'll explain in a moment. So on the Schedule 7, you calculate your contributions, then you look at how much you can deduct, and then you decide how much you're going to deduct, enter that on Schedule 7, and the deduction is then claimed on line 20800. Now, important thing to mention here, because it's not really, because it might not come up otherwise. When we're talking about deductions, notice that RSP contributions themselves can be claimed as a deduction. One of the implications of that, then, is you cannot claim any investment expenses as a deduction if they relate to investments in a registered plan, any registered plan. So if you put money into an RSP, RESP, RDSP, or a TFSA, you cannot claim those investment expenses. And again, the reason is because that investment income is already tax sheltered. And in the case of an RSP, it there's already a deduction there. That's the reason there. This can often trip up people. I have clients come in and will just thrust a large sheaf of papers at me, including statements from their investment house listing the investment expenses. And, some of the expenses will be for registered investments in a registered account, and some are for regular investments in an unregistered account. And you can only claim the unregistered investment expenses. So, all right. And again, anything you don't decide to claim as a deduction in the year can be carried forward and then deducted in a future tax year. Any questions on that so far? You're all with me? Good. As I say, there's a lot of moving parts to RSPs, so I want to just take my time and be real clear about everything. Now, as I alluded to earlier, whether you're deducting them or not, the RSP contributions have to be reported on the tax return on Schedule 7 for the correct tax year. This kind of tells the CRA that these contributions have been made. This can lead to major problems if you don't do this. It can be very difficult to untangle this years down the road. So you need to stay on top of that. Question. Is there a limit to claim in the future? Well, in any given year, you are going to have a deduction limit, right? So notice we talked about making contributions, and they're limited by a deduction limit, right? So this can lead to problems when you contribute more into the plan than you're able to deduct. So, for example, if you put more into the plan than you're able to deduct in a year, then that remaining amount is what's called an excess amount, and you can't claim it. So that will carry forward. That's one of the reasons you might not claim a deduction for your contributions. You might also not claim a deduction if your taxable income is too low to benefit from the deduction, or it would be more advantageous to carry it forward. So, for example, if one year a person is in the first tax bracket and the next year they're going to be in a second or third tax bracket, then you would not want to claim that deduction. Then you'd want to save it for the future year when you would have more deduction room. Now, an important thing to be aware of is that there's no expiry date as to when you can claim RSPs. They can carry forward forever. However, you can only claim them if you have deduction room, and that's based on your earned income. And that has to be generated before you turn 71. Sometimes I encounter clients who have some sad little amount of RSP contribution that they never got to deduct because they never had that final little bit of contribution room, and now they're 90 and they've got like a $5 RSP contribution which never got deducted because they never had the contribution room, the deduction room. So you want to avoid overshooting your deduction limit if possible. At any given time, you can find what the unused amount is by either through the CRA website or looking at a client's notice of assessment. The CRA's website will be the most up-to-date figure. Now, there's an important implication about there being no expiry date. This means if you are doing multiple tax years for someone comes in and they need to do 3-4 tax years at once, you can look at their overall situation and say, you are going to owe tax in year 2 and 3, but if I don't claim your RSP deduction in year 1, then I can carry forward it to year 2 or year 3, and then you won't owe tax in those years and thus not have a penalty. So Uh, just like charitable donations can be carried forward, and some other things can be carried forward, RRSP contributions can be carried forward. And then you can, in situations where you're filing multiple years at once, you can choose which year will be most advantageous to claim them. That's one of the most powerful tools in the tax preparer's arsenal at this level. All right. Um, but just to be clear, then you can claim unclaimed deductions after you turn 71, providing there is some leftover contribution room. All right. And question? Right. You're Mohammed. I think I understand your question. Um, if your contribution room is going to continue to grow in every year you have earned income. So many taxpayers, they have had relatively low or middle moderate income for a lot of years. They may have quite a lot of room in their RSP contribution limit because they've never put money into it. So, but as I was just saying, uh, even if you have that money and were to put it all in, you might not want to deduct it all at once because of the factors I'm just described. You want to use it tactically to make sure you get the best return on it. So even if, say, you came into a windfall, had a lot of money suddenly come into you, you might not want to max out your RSP because if you deduct beyond a certain level, you're not getting a huge tax benefit to it. So, for example, if someone only is making 15,000 in income, then that's less than their basic personal tax credit. So there's usually not going to be a huge benefit to claiming the deduction. But again, you can be really tactical about it. There may be situations where a small deduction will let you qualify for some other credit or something like that. So I don't want to say this is an absolute rule. All right. So as I say, we have unused contributions, and it's important to distinguish these from excess contributions. Excess contributions is when you put in more money than you had room for with the deduction limit. So the contributions are limited to the deduction limit, and when you are uh, under 18, you can only put in 2,000. If you are over 18, you can overshoot your deduction limit by up to $2,000. So this is why this rule applies, because people under 18 already have a $2,000 cushion. They don't get a second $2,000 cushion. When you are over 18, then you can overshoot by up to $2,000. Now, if you do contribute over your deduction limit, it is subject to a 1% penalty tax per month on the excess contributions. This is a real pain to figure out, but in general terms, there are two major options that the taxpayer has. You can either basically you withdraw money from the RSP to get rid of the excess amount, and then depending on how you do it, you would use either a Form T746 or a Form T3012A. One of those will, there's more detail in the textbook. I don't want to use a lot of time on it, but basically one of those you give to the bank beforehand so they know what's going on, so they don't deduct tax on the withdrawal. And one of them you send to the CRA after the withdrawal, and then the CRA says, okay, we know what's going on, and then you're allowed to, you're not penalized for it. Well, it is potentially hard because it's per month, but Christelle, but often the overshoot is not large. Let's think of an example where someone overshoot. So let's say someone has a $10,000 contribution limit, deduction limit, and they have a very generous employer, and they put $1,000 a month into the RSP of the employee. So first 10 months, they're fine. And then only in November, December would they go over. And that first month, they would go over by 1,000. And in the second month, they'd be over by 2,000, right? And, that would still be within the cushion, right? So they tend to creep up to the limit, and then you have a situation where in the last month or two, they're over it by a small amount. And then the contribution limit opens up in the calendar year. So suddenly, once they hit January, the contribution room opens up because it's a new year, and the contributions start being calculated then. So it is a very annoying form to fill out. So we just try to encourage clients to be aware of this limit and not overshoot it. But people can often get into trouble if, for example, they have a generous pension plan at work and they're putting money into an RSP, and they have some kind of automatic RSP contribution set up, and it's just kind of putting money into the RSP like a conveyor belt. But then suddenly their earned income drops, and thus their deduction limit drops. And if they don't take steps right away, and this is not the first thing that anyone's going to think of, then they can get into an overshoot situation. Again, there's more details in the text, but those are kind of the basics of it. All right, so I've done a lot of talking. Let's see if everyone was able to absorb it. Okay. So what I'd like you guys to do is let me know what is the proper order of events. So here are 4 steps with RRSPs. Which one comes first? Okay, let me give you an example which might help. Let's assume that someone is 20 and they are working in their first job. What's the first thing they need to do in order to put money into an RSP? Good. So the first thing you need to do is accumulate earned income. Right? You have to accumulate the earned income first, right? Unless you have earned income, you can't do any of the other things, and you're not going to, be able to do anything until there has been some earned income. All right. So once we earn the income, then what happens next? So the next thing we would do, exactly, you would see how much money can I put into an RSP. You would look at the notice of assessment from the previous year. So if it's someone's first year working, right, that deduction limit would be 0. They would still have the $2,000 cushion, say, but they would need to begin with that understanding that, oh, the deduction limit is 0. I can put in 2,000, but I can't deduct anything yet. Okay, so then what do we do? Yeah, you get it. So once you know how much you can deduct, that allows you to plan and make your RSP contributions during the last 10 months of the year or the first 60 days of the next calendar year. And then, and only then, you claim the contributions, some of them or all of them, as a deduction on the tax return. Right, guys. So, first, you accumulate the income, then you review your deduction limit, you make your contributions, keeping the limit in mind, and then lastly, you claim some or all of the contributions as a deduction. All right, so let's see if you're paying attention. What are some reasons someone might not deduct all the contributions? Their income was low, right? If their income's low, they're not going to benefit from a deduction. If they don't have room, they can't claim it. They think they're going to be in a higher tax bracket the next year. Excellent, excellent. Good. And remind me, when do undeducted contributions expire? Excellent. They don't expire, but you can only deduct them when you have deduction room. So that deduction room is pegged to your earned income up until the time you turn 71. Right? So you can deduct them when you're 90 if you have room, but you can only build that room before you turn 71. Okay, now let's check our time. It's about 7:12. And let me look at the overall scheme of things. Bearing in mind we want some time to check on things. It's only 7:12, so I'm not going to take the first break. We'll take a 15-minute break instead, uh, slightly later on. You guys holding up okay? Your heads aren't spinning around too much? Okay, all right. So I'm not gonna go crazy long here. Do not worry. Okay. So we're now going to talk about some of those other things related to RSPs that I mentioned. Let's pull up our polling again. There's polling. All right, so let's see. And those of you who are here at the beginning will remember this part, but for anyone who came in late. So the terms home buyer's amount and home buyer's plan. These are synonymous, and we can use these terms interchangeably. All right, let's see what you all think. Give you a minute here. Okay, I see people are concentrating around a specific answer. I'd like to see that. All right, about 10 seconds left. All right, good. And WebEx is just going to give everyone a few extra seconds for those people who have it open but haven't made a selection yet. All right, so the answer here is false. As I alluded to earlier, the home buyer's amount is a tax credit, right? The home buyer's plan is not